Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitra Kargamanik. How you doing, D?
Good morning, Will. How are you?
Good. Do you want to start with the disclaimer? I think it's up there for everyone to see.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
And with that, let me share my screen.
Dude, a lot of people are chirping on CNBC this morning that this is the start of the next leg of the bull market.
Yeah. What are they saying?
You had Jeremy Siegel on just talking about, the M2 money supply and how restricted it's become, and he feels we've seen the basically the inflation has stopped, and time to put your feet back into the market. I mean, it's already had
risk on.
Yeah,
we'll take a look at the volatility to the upside. Certainly, a couple things driving the market higher, I think, is the Fed, or some of the Fed speakers are starting to indicate that they're going to start slowing down the pace of increases. So if they're looking at data, and maybe now they're saying, okay, we're going to slow down. They're not going to pause yet, but they're going to slow down the rate of increases. I think that was kind of expected, though. That was priced in December, but now we're getting a little bit of confirmation. Then out of China, I think some positive economic developments. They're going to try to stimulate their economy, rescue their property sector. And it looks like now America and China are trying to talk on friendlier terms. So I think those are feeding into positive sentiment. Still a lot of money out there. And we'll take a look at that.
You start to look at some of these stocks, they have, definitely moved off their bottoms.
Yep. So look and we're seeing a lot of Chinese stocks actually, popping. I think even Warren, well, he didn't buy Chinese stock, but he did invest in Taiwan Semi, big investment. So that shows a little bit of confidence.
Well, really, that is. I think majority of its operations are in Taiwan, right? The production of the semiconductors, which.
Yep. So that's helping out. We still have rate hikes though coming. We're gonna probably, it looks like another 0.5 point in December, at least. Inflation, it's not as hot, but it's still elevated. So I don't think that the Fed has wiggle room to just go on a pause. They're probably indicating that they would, if they have to err, they're going to err on the side of being too aggressive, and instead of not aggressive enough. And that's because inflation is high. We're still in the 7%. Maybe it's not 8.7%, but it's still high.
I guess the PPI number just came out too, and it was less than expected. They were expecting 0.5, and it was actually 0.2.
Okay, so on that front, a lot of good news there. If you guys are joining us for the first time and you have any questions, put those questions on the live chat on YouTube. Will's watching and he'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. Click on that link. It takes you over to Zoom. When you get to Zoom, click on raise your hand. It'll prompt you to turn on your video camera. You don't have to turn on your video camera. Once we let you in, everybody could hear you, but then you could ask your question live. I think what we'll do today is, while we're waiting for questions to come in, as usual, we'll take a look at the pre-market report, see what's trading at pre-market hours. I think I'll go to SPY, kind of see how the market's been moving compared to what the options markets have been expecting as far as range. And then maybe we'll take a look at how the straddles have been performing week to week. So that report keeps track of option premiums and how they perform from start of week to end of week. We keep a rolling tally. We'll take a look at that, get a sense of how the realized volatility is performing versus the implied volatility. All right. So pre-market report, these are stocks moving or trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 307 stocks made our percentage gainers list, 56 on the percentage decliners. From that perspective, looks like we're setting up for a more bullish bias at the open. I'm going to filter this list down to just S&P 500 companies. We'll take out small cap stocks, ETFs, leverage products, closed-end funds. We'll take all those out just to focus on S&P 500 stocks. And to do that, I'm going to use this filter here in ETF, drop it down. You got a list of ETFs there. When you choose one of these ETFs, the list below will get filtered out by holdings in that ETF. SPY, the first one is SPY, S&P 500 ETF. Let's select that. When you do that, as you can see, the list below gets filtered out by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here we also got 62 stocks made our percentage gainers with one on the decliners. From this perspective, again, looks like a more bullish bias at the open. Let me see if there are no questions that came in yet. Maybe I'll take a look at SPY first, and then we'll go to that report to take a look at what's going on in the option straddles.
Sounds good, D.
All right. Let's take a look at SPY here. And here we could see this is in the pre-market. It's indicated up 1.8%, $7, more than a $7 move. This is where it closed, 395, 12, pre-market trading 402.39. Let's see what the options were indicating. The move, 1 day, 2 day, and so forth, because this is still a pretty big monster move at the gap, right? 1.8% gap is pretty big. I'm just going to come down here under options, and I'm going to click on this activity, and it shows yesterday's options activity. Here we talked about, these are the different expirations. So November 14th, that expiration expired yesterday. Today's November 15th, and so on. We got implied volatility. So these are the at-the-money IVs for each expiration. The skew, volume by expiration, open interest by expiration. And over here, we have the at-the-money straddle. And the at-the-money straddle we display in two ways. One is the dollar cost. So the dollar cost is here based on the midpoint price of the straddle. This is as of 30 seconds before the market closed. So we take a snapshot 30 seconds before the market closes, because right at the market close, the options tend to widen out. And right now, here was the range expected today. The range expected today was 1% or $3.92 in either direction. You buy, call, buy, put, you pay premium for both. The stock has to move by a big enough percentage in either direction to cover the cost of both options. Today, $3.92, you can see 1%. Going out to November 16th, that would include today, tomorrow, a 1.4% move, $5.50. Going out to November 18th, I believe that's Friday. That's a 2% move, $7.85. So we're all the way over here at this point, right? We're almost, well, it just declined a little bit, but we were, I think, right there at 2% in a pre-market, you could see how volatile this just that pre-market move is, and how volatile even to the upside the market is. You know, we've been talking, as you raise interest rates, things become less liquid, you know, because you're taking liquidity out of the markets. So that's just to show you that move over here, you know, almost covers at this point what the straddle was priced going out to Friday, right? Let's take a look at, and that's still 4 business days of trading, right? So you got still 4 business days of trading on top of that. Let's take a look at how the options straddle. You know, let's see how SPY is doing for the month, actually.
Hey, D.
Yeah.
We did have a question, a little bit of delay. Someone was asking, is there a way to have the historical data of pre-market volume for only one specific stock? I guess, I'm assuming he's referring to a move in the stock, how it's reacted before.
Let me see. So these are the pre-markets. So there is a table. There's actually a minute by minute table, in total volume, day by day. They could go back this way, right? That would be day by day. You could download it. Let me see if there's a pre-market. Yeah. I can't recall if this. I don't know if it's. He's probably looking like for a list, right? Like daily, a list of volume.
Yeah, if you could let us know in the pre-market what data you're looking for, it would be helpful. Or you can come on live by clicking the link, the Zoom link up top, and that will lead you over to the chat.
Yeah, let me see what this. Let me see if this one has it. All right, so here. Okay, yeah. So over here, you know, opening, closing trades. This lists a couple things here. It shows the pre-market volume day by day. All right. It shows the pre-market VWAP. So this is what the VWAP was in the pre-market. This shows the opening price. So that would be the opening auction, right? So that's like a single price auction. That would be the volume at the open. So the volume at the open wouldn't be part of the pre-market, right? That would be the first trade, official trade of the day. That's how much you gapped up from the previous day. Then you got the closing price. So the closing price is also a one price auction. And then you got the volume on the close. So all right here. Hopefully that helps, right?
Well, let us know if that helps.
Yeah, actually, and you have the after hours volume and the after hours VWAP. So it's kind of like, you know, everything here, except I guess we didn't include the regular session here, but this is showing us pre-market, opening trade auction, closing trade auction, after hours activity. Okay. And I believe these are the averages. Yeah, these are the average pre-market volume, average volume at the open, average volume on the close, average volume after hours. Okay. So hopefully that helps. Let me know if there's a follow-up question to that.
Perfect.
Yep. Let's go under tools and seasonality. And here we are right now, you know, came off a big gain in October after, you know, two months of losses. Here we're adding so far 2.3% month to date, not including today's. And we could see November has been, I think, the best performing month historically. On average, gained 2.8%. The median return 2.7%. We're at 2.3. If we add another 2%, we're getting, let me see, the high 10.9. So you can see, we're like almost going to be over 4% if we, today, if we close anywhere around here. So let's take a look at the straddles, these are, because a lot of people just do that, sell straddles, buy straddles, right? That's their strategy, looking to sell premium, buy premium. How did that perform in the last 12 weeks? I'm going to go under here. Sorry, options. And we're going to take a look at this straddle and wing back test. And I'm going to filter down this list because it has at the money straddle, it has out of the money calls, out of the money puts, and 3 different ways we could look at the money straddles. So the first thing, let's just look at the money straddles. This is buying a call, buying a put with the strike that's the closest to at the money. We'll select that. And when you trade that the money straddle, you could buy the, and the time frame here, the time frame is 1 week. We take a snapshot Monday morning at 10 a.m. So we let the options trade a little bit so the markets start to tighten up. We take a snapshot at 10 a.m. and then we compare that snapshot. We let it trade all the way to Friday to see where those options are Friday at the close. Okay. Couple ways to do that. The money straddle, you could just find the nearest term strike, the strike that's closest to the stock price, buy the call, buy the put, hold it to Friday. You could buy the call, buy the put, and hedge the delta. That way you're delta neutral from the start. What that means is, if the stock is never exactly at the strike. You're not going to always find exactly a strike price equal to the stock price. You could have a strike of 100, but the stock could be 98. And if the stock is 98, that means the put is worth more than the call, right? Because it's already in the money. When you buy the call and you buy the put, that means you're going to have some delta. You got a little bit of a short bias because the put is more in the money. The put, you're paying a little bit more for the put. To offset that, you would have to buy the delta, buy some stock. So there's a delta neutral from the start, and there's a rehedge. And since the stock moves from day to day, it could go above the strike, below the strike, it creates a delta. And when it does that, what we do is by the end of the day, we hedge the delta to get back to neutral. Okay, so neutral is that for dollar move, theoretically you're breaking even between your hedge, your stock, and your options. Okay, I'm going to take a look first at we're going to leave it at the last 12 weeks. So this is a rolling 12 weeks, and let's look at unhedged. Just buying the call, buying the put, closest strike, what happened. And you could see here, this is right now sorted by biggest market cap stocks. Apple, 58% of the last 12 weeks. That straddle was profitable, meaning if you bought it by Friday and did nothing between Monday, 10 a.m. to Friday, the close, 58% of those days, 58% of those observations, the straddle was profitable from the long side. On average, gained 29%. Okay, median return 20%. And if you open that up on the view, it gives you, these are the strike expiration. So you can see it starts November 7th, 10 a.m. This is where the stock was. This is the call price. This is the put price. This is the total premium of the call and put. November 11th, right at the end of the week, right before the market closed, the stock was 149.52, up almost 10%. So you could see that this was the call. The put was worthless, but the call was $13.52, meaning that this straddle gained $717, 113% return on the original amount at risk. That's so even so got Apple, Microsoft, Google, Amazon, Berkshire, Tesla. The top ones all have been showing positive gains. Here's one. You could even have a 42% win rate, right? But the returns could still be positive, because when you own options, right, you're not limited to your upside. You could make more than 100%. You can make 200%, 300%, 400%. So if there's a very big week of big return, that's going to move that average up. The median return you could see was -4%. That's the return right in the middle, but there must have been a very big return in here, that skewed up the averages. And here's a 247. This actually goes back more than 12 weeks. So the calculation up here is for 12 weeks. The data here goes back longer. Okay. Just shows you how volatile this market has been. In the last 12 weeks, you got your top market cap stocks, and the top 5 I counted, all on average, those straddles were profitable.
Hey, D.
Right? Yeah.
Rob is asking, can you just show the steps to click to get to these pages?
Yeah. So this straddle return under options, I went over here where the tools are, and I clicked on this straddle and wing back test, and then took me to this page. Now, this here, let's look at S&P 500 stocks. So now I'm going to filter out just S&P 500 stocks. We could take a look at, the highest median return. Okay, the problem is some of these, so this is another thing to look out for, is that these wide ones, you can see here the average bid-ask spread's $1.60. We only had one observation. Why do we only have one observation? When things are not too wide, or we find that they're illiquid, we skip that observation, right? Because we don't know where the market really is. If it's so wide that it doesn't even make sense, it's ridiculous, it's illiquid, we just skip it because we think it's not a good observation to include. Let's do this, that in the last 12 weeks, we're going to say that we needed at least 12 observations. This will take out those really liquid stocks that we just could not, didn't feel comfortable using the data. Now that we did that, you can see all these have 12 observations. 12 weeks of data all had 12 observations. And these are the bid-ask spreads of the stock. I'm sorry, of the option. All right. I did filter it, the median return. So this one popped up, NOW, as the highest median return. Again, just keep in mind that we're looking at a snapshot of the midpoint, and these bid-ask spreads are wide. So it is assuming, where did the mark to market of the options go, right? The midpoint of the market to the midpoint of the market, from the midpoint to the beginning to the midpoint to the end. Where you get executed, we have no idea, because execution is not possible to to tell. That's why the industry really looks mark to market, which is midpoint market. You could see here, this is the midpoint of the call, midpoint of the put at the start. This is where the stock is. It's a high price stock. Stock moved 14.5%. The call, you could see, went from $9.80 to $52. The put went from $9.70 to $0. So you did lose all the premium on the put. But the call that you bought for $9.80 was $52 at the end of the week. It made up for the loss in the put and the cost of the call. Okay.
Lauren mentioned, he said, to me, this means that options IVs have been underestimated the realized volatility. Options are not being efficiently priced.
The options were underestimating the moves for the week. So what the options were pricing at the start of the week, they were underestimating. That's correct. We could look at it also from a hedging standpoint. What if we hedge? All right, so daily rehedge. In other words, the stock is going up, we get a delta, if you're short, you buy it, if you're long, you sell it. And this will give you a more, not just the move we looked before was just the entire move for the week. How much did the stock move away from the strike from Monday to Friday? This looks at daily moves back and forth. So rehedging is realized volatility. It could go, volatility you could be up one day, down one day, up one day, down one day. At the end of the week, the stock could finish at the same spot, but it had a lot of volatility in between. And that we would look at a delta rehedging strategy, because the delta rehedging strategy would capitalize on that realized volatility. All right. Here, I still have it sorted here by highest median. On that strategy, Nike showed up. Okay, daily rehedge. Nike, 75% of those 12 weeks, that strategy was positive, right? 25% loss, positive, 75% on average for the week. Average gains 36%, median return 51%. Let's take a look at that. And this is showing us more than 12 observations, but I have it set to just give us the summary of the 12. And again, this is where the stock was beginning of the week, end of the week. These were the options, beginning of the week and end of the week. This is the rehedging strategy. Okay. And you could compare that. The rehedging strategy, right, actually performed worse than the unhedged, which is telling me that a lot of the move was one way. Okay, because if you have a lot of back and forth, then this one would have outperformed. If you have a lot of the move going one way, then you're better off not hedging, right? You're better off just letting it go. So in this instance, you could see here that for this week, it would have been better to let go. The stock was up 12.3%. That's last week. Okay, this week, we're not going to have the new stats until next Monday, right? Because this is based on weeks of trade. We're right up at 9:30. I'm going to stop here.
Yeah, we did have a couple questions again that popped up about the volume after hours before from a new user, and I emailed to you. Maybe we can get to him tomorrow. Great job, buddy.
Yep. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day.